Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, we'll break down the deluge of headlines out of Washington as President Trump targets housing, defense, oil, and more. Plus, we'll bring you the biggest takeaways from CES so far and what that means for the AI industry. And we'll discuss how to invest in the sports and entertainment businesses through the launch of a new ETF. Let's take a look at the major averages right now. We are seeing a mixed picture. The Dow is actually gaining a little bit, about 60 points right now, not even a tenth, or about a tenth of 1%. We've got the S&P 500 trading lower by about a fifth of 1%. The Nasdaq leading declines today, down by about 9/10 of 1%. If you look at the sector view here and what's doing best and worst, not surprisingly, we are seeing tech here, as I just mentioned, with the Nasdaq underperforming. Tech is down. We've got consumer staples, industrials, and energy today trading higher, as we have the various dynamics going on in the market. Looking at the NASDAQ 100 more specifically, you got a lot of red on your screen related to what's going on in big tech. It's interesting. We've got these reports out that Nvidia could be getting closer to shipping its H200 chips into China, but those shares are trading a little bit lower. Broadcom shares standing out to me as dark red. And Micron, of course, we've seen those stocks, especially Micron, do well in recent days. So perhaps a little bit of a pullback on the back of that. But overall, as I said, seeing markets mixed to slightly higher when it comes to the Dow. Let's take a look at the Dow, why don't we, since it's the outperformer here today, even though you've got some significant red movers on the screen. We've got Merck, Honeywell, Coke, P&G as some of the outperformers today, as we continue to see some rotation here to start the year. Rotation is some of the losers from last year. And then let's get to the sort of geopolitical macro backdrop here, because in less than a week, President Trump has captured the leader of Venezuela, pushed for a takeover of Greenland, announced plans to remove institutional investors from the housing market, and called for a $1.5 trillion military budget with some strings attached for the defense companies. Here to break down the feasibility of all of this and what investors need to be watching is Wendy Schiller, a professor of political science at Brown University. Wendy, it's good to see you. Now, we kicked off the week, of course, with the news out of Venezuela, and I was struck by a take from Axios, where they talked about that this is a sort of remaking of the global order, a post-disruption society, they called it. And one that is not sort of a temporary blip, but this is it, right? This is our now status quo. Do you agree with that? And if so, what does that mean for how we should sort of frame these events that I've been talking about?
Julie, I think it's interesting to think about status quo with President Trump, who's not really a status quo kind of guy. It's hard to be a disruptor and then establish some sort of uniform policy. This is a projection of U.S. power. And this is what Trump has been trying to do in different ways across the world, whether it's negotiating peace in the Middle East, whether it's trying to push Russia a little bit more to the table on peace with Ukraine. He wants to be the guy, and he wants the United States to be the country that, gets rid of bad leaders and puts an end to conflicts. So Venezuela fits really nicely in that box, and there's a lot of oil at stake. So there's always a side deal with Trump, and he can argue Ukraine has minerals, Venezuela has oil. So to think about this as a sort of predictor policy, I think, is a mistake, because we just don't know what this president will do. But certainly he believes in, if you have power, use it, which ties in, as you talked about, with Greenland and maybe, increasing the defense budget. Congress just passed the defense authorization bill literally a couple weeks ago. So it's unclear to me what that new vehicle would be to spend more money, but he's now starting to talk about it.
I want to ask about Greenland in particular, and again, this sort of view that if you want something, you just go out and get it. We were watching Polymarket odds, for example, which seems to be like the new thing that we're all taking our cues from. And we are seeing a tick up in the expectations that the U.S. will buy Greenland. It's only at 15%, but that's up pretty considerably from where it was even just a few days ago. How do you think that situation plays out, and what will it tell us about, again, this sort of approach on the part of Trump?
Well, history can be instructive, even for a president who doesn't always follow, quote unquote, the rules or precedent. The Louisiana Purchase was also a purchase of land. It really solidified our westward expansion. But even Thomas Jefferson needed congressional authority and permission, and the House and Senate voted on that. They voted on the actual expenditure of the money and the treaty. So, signing a treaty to sort of take over or buy Greenland would be one thing, but coming up with the money and using it legally, I think, would be more problematic for the president. So he'd need the House and Senate GOP to say yes. You're already hearing pushback, pretty strong pushback from Senate Republicans that they don't want any part of this. And then, with affordability and consumers worrying about grocery prices and housing, it's hard to explain as a Republican that this is what you're bringing home to the voter in 2026, getting ahead of the midterms.
Well, you would think that Venezuela would be a tough sell on that front as well. And yet the president has gone and done it, Wendy. I mean, how do you think that is going to play in terms of the midterms and feeding into the affordability question?
Well, at the moment, that military operation cost lives in Venezuela, but U.S. service people were not killed. And I think that's the big sort of line that Trump doesn't want to cross. Obviously, no president likes to do that. But voters will say okay to doing something like that if it's a one and done. Plus, there's oil. And even though gas prices are relatively low, and the oil that Venezuela produces doesn't naturally or easily translate into a gasoline, in other words, dropping gasoline prices, at least people can understand, okay, there's some interest there. But Greenland shipping lanes, business practices, that's a much harder and more complicated sell. So I think that's where things get much stickier for the president and the Republicans.
Wendy, there's been a lot of talk about, with the president making this move into Venezuela and whatever else he might do, the implications for leaders around the globe. Will they take their cues from this? Will they be emboldened to make similar moves? I'm curious your take on that question.
Julie, just thinking about the U.S. perspective and what Trump wants to justify, thinking to, Iran, for example, we've been working hard. We took military action. We'd like to see that regime change. Right, so regime change is something that Trump sort of promised he wouldn't get involved in 2024 when he was running. But Republicans and Democrats alike, presidents like to see more friendly leaders. Maduro was not considered a friendly leader, neither was Chavez in Venezuela. And certainly the Iranian regime is considered a threat. So I think, I'm not sure it emboldens other leaders around the world to do something against U.S. interests. I think now it just adds another layer of unpredictability on what will this president do to accomplish regime change for countries he doesn't think do business well with the United States. And he's putting them on notice that he will take action.
Wendy, when you put all of this together, we're speaking to retail investors here at Yahoo Finance. What do you think they need to know as they watch all of these geopolitical events, which have had not much effect on the market, by the way, but what do you think is most important for them to remember as they watch all of this?
I think two things. One is, what's the exit strategy, right? What is the plan? Do you get mired down? If you get mired down, then we get much more complicated politics and it gets expensive. So I think that's the first part. And how does President Trump raise the defense budget, but then say to defense companies, you can't buy back your stock? What are the strings attached with greater support and use of the military for companies that invest in defense contractors? And they're in every congressional district in the country. So that's a widespread effect. So that's what I would look at. The second is, what happens if the Republicans get so weakened going into the summer that it's quite obvious that Democrats will win the House back? What does that mean for regulations? What does that mean for appropriations? What does that mean for Trump's exercise of power unilaterally? These are things to be watching for. So getting involved, one and done, going in, getting what we need and getting out, that seems like it won't create instability. But anything that doesn't have a clear exit strategy, going into Cuba, going into Colombia, anything else that's been, mentioned on the table, that should start to worry people because it becomes less mobile in terms of the United States' position to get out without incurring too much damage.
And Wendy, finally, I got to ask you about this upcoming tariff ruling that's expected from SCOTUS. Or from the Supreme Court, could happen as soon as tomorrow. What are your expectations around that?
The Supreme Court is very difficult to read. We sort of got the younger cohort, right? We've got Kavanaugh, we've got Coney Barrett, we have Gorsuch. It's unclear what they'll do. It seems as though from the oral arguments, they did not think the president was using the right instrument to impose these sweeping tariffs without congressional action. And certainly it is constitutionally Congress's job to control our tariff policy for the most part. But the Trump administration has been rolling back some of these tariffs. Even pasta from Italy, for example, they just sort of backed off on a major tariff there. They've been slowly kind of mitigating or rolling them back. I think a little bit in anticipation of getting a ruling that says you need to find a new vehicle or justification for your actions, and the fact that people are starting to believe that tariffs have an impact on the prices of things that they're buying. So I think the Trump administration is adjusting, and they will continue to adjust no matter what that court ruling is.
Yeah, tariffs are probably not going anywhere, in other words, or at least even if they change a little bit, they're not disappearing. Wendy, good to see you. Thank you so much.
My pleasure.
Coming up next, we'll get some takeaways from CES and the implications for the AI trade. Stay tuned. You're watching Market Catalyst. Nvidia reportedly close to getting approval from China to ship H200 chips into the country. According to a report from Bloomberg, that approval could come as soon as this quarter. Meanwhile, Reuters reporting that Nvidia will require Chinese customers purchasing H200 chips to provide full upfront payments. All of this in the wake of CES, where we got lots of announcements from Nvidia, as well as many other big tech companies. Joining me now is somebody who has been at CES, Patrick Moorhead, Moor Insights and Strategy Founder, CEO, and Chief Analyst. Good to see you, Pat. So I want to start on this Nvidia China stuff, and then we can get into some of the other CES takeaways. This back and forth on China, what do we make of all of this at this point, considering it has been such a back and forth situation?
Yeah, so Julie, thanks for having me on. And I've been pretty consistent with this whole Nvidia China analysis, which is until the cards get shipped and the checks are cashed, it's not a done deal, because anything can happen at the last minute. And that can happen, China authorities coming in and just saying no for the 10th time, or the US government saying no for the 27th time, and this push and this pull. And it's funny, we're talking about H200s now that are significantly higher performance than the previous debate, which was around a card called the H20, which was about 1/10 of the performance of the H200. I think what this does show is just how long the conflict, this disagreement has been going on for so long that an entire generation of cards has happened. That's how long this has been going on.
I mean, but that also implies that if Nvidia does end up shipping and booking this revenue, that it could be higher, right? Because if it's a new generation, I assume those chips are pricier.
Yeah, we're looking at about a $30 to $40 billion lift for Nvidia. And if you just do simple numbers, $300 billion in revenue would be 10% lift on that, which, by the way, $30 billion now is significantly higher as a percentage if you go back when the conflict fully started. So it is a relevant amount of business. This doesn't mean that China will be completely open, because that could be, gosh, a tremendous, probably $100 billion opportunity. A $50 billion opportunity long term for Nvidia if they let the floodgates open.
Yeah, it doesn't seem like, at least according to reports, that that's happening. And as you say, we'll see when it actually, if and when it actually happens. We'll wait for the actual booking of that revenue. So let's take a look at what we learned from CES. And for Nvidia itself, there was all this excitement around the actual shipping of Vera Rubin, which is its latest generation AI. As somebody who is really steeped in this stuff, put it in perspective without getting too wonky. Why is this such a big deal?
Well, it's such a big deal because it used to be that we would do new chips every 3 years, and then every 2 years, and now it's every year. And not only is it one chip, it's 6 chips with a very complex rack system that it goes into, a very large 2-ton refrigerator looking rack. And therefore, when complexity goes up, risk goes up. And it was such a big deal for him to say that it was shipping. And if you remember, there was a lot of consternation about the prior generation. How was it doing in the ramp? How was Blackwell doing? And I think what this did, it really eased some fears of investors that this next generation would ship. That means higher revenue and higher profit dollars for the company.
Well, I'm curious about the higher revenue piece because he also talked about higher efficiency, right? For lower, potentially meaning lower cost per chip if you're getting more out of them. So why does that then result in higher revenue? Like, do clients have to buy fewer of these, or will it allow them to buy more?
In a normal world, that would be the case, that clients would buy less because Vera Rubin is a huge advance in cost per token. What's happening, though, is this unrelenting demand for the amount of tokens. They might be increasing efficiency by 10x, but demand is going up by 50x. And that's why Nvidia revenues are going to go up so much this year for calendar 26.
All right, Pat, we got to leave Nvidia aside for a moment. Besides that, like, what was the most interesting thing to you that happened at CES?
Yeah, so I think it was all about robotics, and whether that was Qualcomm going all in robotics and even pulling some major customers in there like KUKA and Figure. I think robotics, we all talked about it being the next wave. And what I saw was absolute proof points in the ecosystem, all the way from China to the United States and everything in between, that we are closer to reality. I would say the second one would be the further digitization and automation inside of the car. Right? You saw companies like Synopsys. I would say third would be Intel giving investors confidence. You saw a big pop yesterday, confidence about their latest chip that is manufactured on the latest process. So that was a big deal for investors. But I also think it was another proof point on the comeback trail. Even AMD had some huge announcements showing a little bit about their next generation MI 500 and giving investors higher confidence that their latest and greatest racks that are much more competitive with Nvidia and will be deployed into OpenAI, just a higher level of confidence.
Pat, somebody earlier in the week pointed out to me that what used to be known as the Consumer Electronics Show and now is formally CES isn't really a consumer electronics show anymore, right? It's more enterprise, to your point, as you talked about all of those things. But there is still consumer stuff there. And that used to be mostly what we talked about, the cool gadgets that we were maybe eventually going to see in our lives. Did anything stand out to you on that front? I know there was like a vacuum robot that can climb the stairs kind of thing. Like anything there that you thought was particularly fun?
Yeah, I mean, as you would expect, it was all about consumer AI, right? And I think the most exciting and relevant breakthroughs were AI in healthcare. Scales you could get on that could determine deeper levels of vascular health. I thought that was a big deal. And yes, the home robot, the folding robot, I think that had been shown 60 years ago, which is a very crude version of a robot that did your laundry and did your dishes. But I think reality of generative AI and agentic AI actually make this a reality. I mean, I think we're 3 to 5 years from the reality of a home robot doing something more sophisticated than, let's say, a one shot, doing one thing and doing it really well. And the reason for that is quite simple. The safety challenge of a robot, 1,000-pound robot doing something very risky in your home, but also even the amount of energy and batteries that are required to make these multi-purpose robots do something interesting and useful and very reliably.
Yeah, it is not an easy challenge. And I should have known that the healthcare stuff would stand out to you because I know you're guys interested in that kind of stuff. Patrick Moorhead, thank you so much. It's good to see you.
Thanks for having me on. Bye, Julie.
Bye. Coming up, we're live at the NASDAQ looking at some of the top analyst calls of the day. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke DiPalma. We're live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street, because today we're watching shares of Alphabet, Gap, and Albertsons. First up, Alphabet, because Cantor Fitzgerald's upgraded the stock to overweight from neutral. The analyst said it has the strongest footprint across several layers in the AI tech stack, adding that the tech company's decade-long investments have enabled deep competitive moats, and with regulatory headwinds easing, Google could benefit by leveraging its distribution and consumer and enterprise in the coming years as AI advances. Now, Alphabet is well liked on the street. It currently has 19 buy ratings, 2 holds, and 0 sells. Next up, let's take a look at Gap. UPS upgraded the stock to buy from neutral, and in a note to clients, the analyst said the apparel retailer is approaching an inflection point in sales and earnings, and that the market is not fully pricing that in yet. It expects the company's sales and profit growth to improve over the next 12 months as new initiatives begin to contribute and performance stabilizes around that activewear brand Athleta. There are currently 19 buys and 7 holds on the street, but no sells. Lastly, let's take a look at grocery chain Albertsons. The company reported third quarter results on Wednesday that beat earnings estimates but missed on revenue. It also lowered its sales forecast for the year. All that led to BMO Capital and Barclays to cut their price targets on the stock. Keep in mind, the average price, 12-month price target on the street is now around $22. Plus, Deutsche Bank resumed coverage on the stock with a hold rating, and there are now 14 buys, 8 holds, and 2 sell ratings on the street for Albertsons. Keep it right here on Yahoo Finance, because we'll be tracking all the market moves and top calls throughout today's trading session.
While global healthcare was an unloved sector for most of last year, it did manage to outperform in the last leg of 2025 amid reduced policy uncertainty. But even as healthcare enters the new year on better footing, there remains much to navigate. To outline the path ahead, we've got Raymond James Managing Director and Washington Health Policy Research Analyst Chris Meekins. And there's still quite a bit of policy uncertainty out there, Chris. It's good to see you. I do want to start with the Affordable Care Act, because it ain't dead yet, I guess, in terms of that extension. There's still some reports lingering this morning that Senate Republicans might be making progress on some kind of compromise. I mean, what do you think the chances are at this point?
Hey, Julie, thanks for having me again. Yeah, I mean, this is the issue that won't die. We started writing about it in July. I think it was Halloween of 2023, and here we still are having the conversation. So look, what the reports show is that there are some Republicans who have been the ones saying they want a deal for months, saying they feel like they're close to a deal, but what we've seen from Democrats is they don't think they are. There's a big battle over abortion language that's still in place, but even some of the core things that Republican Senator Moreno has said from Ohio about minimum monthly payments is something that very senior Democrat Wyden has said no to initially and pushed back on. So I continue to think the odds are less than 20% we see any type of a deal. We're now past the deadline. People understand where things are, but also from signups at the same point last year where we had 16 million people late in December, we're now at 15.6. So we haven't seen a huge drop off initially of people signing up for coverage, despite the fact many are going to have to pay more.
Gotcha. What about some other sort of policy insurance changes coming down the pike this year? I know you're watching Medicare Advantage, for example, and any kind of rate changes there.
Yeah, we're excited. We think Medicare Advantage is a really positive place to be. There's been a lot of rhetoric in 2025 about what could come from it. But when you look at what really happened, they had a positive rate update. They had $13 billion more in STARS funding coming their way. They allowed voluntary agreements from the insurers on prior authorization instead of regulating it. We think you're going to get a positive rate update the first quarter of 26. And then we have to watch as we get into November if they make some changes. But the administration doesn't want to cut Medicare, in our view, before the midterm elections.
Gotcha. In terms of policy changes, there's something else on my mind that I want to ask you about, Chris, and that is the new food pyramid getting a lot of attention. Some in the nutrition community saying this is not a bad update. They have maybe some reservations, but I'm curious, when you see a food pyramid change like this, what effect does it have in reality on on the food system, on the healthcare system? Like, what force does this thing have?
Well, let me start by saying they're going to have to claw my Coca-Cola from my cold, dead hands at some point in the future. But in the near term, I mean, what they're trying to say is, look, they want more protein, less added sugar, more natural food types, but they're not going to ban these types of activities. They're saying there are appropriate types of fat and good fats that are positive. They remove the alcohol. 1 drink for a woman a day, 2 drinks for men a day, and saying just to drink less alcohol. But generally speaking, these changes are more recommendations than binding. They can impact areas like menu rules and procurement guidelines, around school meals, WIC, SNAP, Head Start, some DoD funding, food programs as we go. But overall, these are new recommendations, and I'll let someone who's more qualified than I am, maybe a healthier eater than I am, make judgments on whether or not they're good or bad.
You got to give up that Coca-Cola, Chris. Come on, that added sugar can't be good for you, but that's okay. It keeps you going, gives you energy to talk to me. So
exactly. Without that, I wouldn't have been here this morning.
Okay. Well, then keep that Coca-Cola coming. I want to ask you, I guess, more broadly about, the new HHS and the various agencies underneath it, and whether thus far, for the healthcare industry at least, this RFK Jr. leadership has been as problematic as maybe anticipated. I mean, we know for some of those vaccine changes, those recommendations have been troubling to some in the medical community.
Yeah, the vaccine changes are obviously the most consequential, I think, largely speaking, of the changes we've seen. And there are real concerns about childhood vaccination rate and what the impact of that could be. And the CDC officials that are experts in this were largely bypassed for those decisions. So we just have to acknowledge that. However, when we look at most other areas of healthcare, what we've seen is a lot of rhetoric that sounds bad for industry. But when you look at what they've actually done, it's been more bark than bite. When we look at the pharmaceutical industry, they talked a big game on going after the industry, but the industry, got around tariffs. The MFN isn't consequential. There's a reason Pfizer was up the day the deal was announced. We look at the trade agreements. The UK, they're just going to pay more for pharma, which is good for the industry as we go. The biggest issues for pharma are really uncertainty at FDA, and they have right to be concerned about that, from the staff cuts as well as the somewhat manic nature of decision-making over there, and to some degree crony capitalism that's happening. I think when you look at the insurers and healthcare, largely speaking, yes, Congress has passed big changes with $1 trillion in cuts to Medicaid over a decade, but those haven't gone into effect yet. MA, you've seen a really positive environment. So there's been a lot of rhetoric, but the reality overall has been favorable for industry. And I think that's why, if you look at how healthcare performed X the Mag 7, it actually outperformed the S&P last year. If you take United Healthcare out of the agenda and some of the managed care companies, healthcare, largely speaking, the subsectors had a really good year in 2025, and I think that's underappreciated.
Yeah, and some of those big drug makers in particular, which was a surprise. To your point, there was all that rhetoric about coming down on drug pricing, and then some of these drug makers struck deals with the administration, and it's stuff that didn't necessarily negatively affect their revenue. I'm also curious on the regulatory approval process for some of these things. Like, we're waiting, for example, for the new Eli Lilly oral obesity medication to be approved. What do you think that timeline is going to be like for that one, and in general for the FDA?
Yeah, it was sooner than we thought for Novo's drug. So that was fascinating to watch how quickly they did it and where they are with that. I think they are looking to move quickly on the Eli Lilly drug. So sooner rather than later, exact timing to be determined. But what I will think is interesting, and Lilly's a great example of this, in an environment where you have products that we're going to go head to head and compete on price, yes, the agreement with the companies, Novo and Lilly from the White House, theoretically lowered prices from what they are today, but it probably created an artificial floor that was higher than what competition would have led to had they not created this minimum payment that they agreed for these products. So it actually ended up probably being a win for the companies on a whole as they look in the out years, making this deal with the White House compared to what the market would have allowed.
And Chris, one other sector I want to ask you about, or subsector I want to ask you about, are the pharmacy benefit managers, which has really been under fire in Washington. And, if you talk to them directly, they'll say, well, we help keep prices lower. We help negotiate prices for large groups, including employers, for example. Are they getting much of an audience for that argument in DC?
They are the favorite whipping boy of everyone at this point, it seems. They continue to be in the headlines. They're going to continue to get whacked. Pharmaceutical industry goes after them, and everyone else just doesn't want to be targeted. So they're piling on at this point. I think we do have to at least acknowledge the fact that there's only one government health program that I can remember that's ever come in under budget. And that was Medicare Part D when it was designed. And the reason for that is they negotiated much lower net drug prices than the government thought they would be able to. And that's a credit to the PBMs. Now, is it possible some of the business practices are resulting in artificially increasing the list prices of drugs? No question about that as well. But does there need to be a negotiation? I think is something people are open to. With that being said, if Congress is able to do something bipartisan on healthcare, which is a big if, capital IF for if, PBM language will be included, but the result of that probably will be to the benefit of the big three and push everyone who's not the big three, 80% market share, out of business. So the big three probably get bigger because the ones that are doing these things that people dislike the most about retaining rebates are really the smaller players that don't have the purchasing power to get the best prices for these pharmaceuticals.
Interesting. And for people watching, the big three are what? UNH, CVS?
Yeah. And Cigna.
And Cigna. Gotcha. Okay.
You got it.
We'll know what to watch beyond that then. Chris Meekins of Raymond James, Happy New Year. Great to see you. Thank you.
Happy New Year. Have a good one. Thanks, Julie.
Now time for some of today's trending tickers. We are watching Goldman Sachs, Paramount, Skydance, and CrowdStrike. First up, Goldman. The bank has reached an agreement to move its Apple Card business to JP Morgan Chase. Now that transaction brings to an end a years-long headache for the investment bank as it made an attempt to push into consumer banking. The deal still requires regulatory approval and it is not expected to be finalized for 2 years. Those shares of Goldman and JP Morgan, little change today. Next is Paramount Skydance. Yes, we're talking about this one again. David Ellison's company has reaffirmed its offer to buy Warner Brothers Discovery for $30 per share. Paramount says its offer represents the best path forward for the company. Paramount also says it has cured every issue raised by Warner, including the financing of the deal. And finally, CrowdStrike. The cybersecurity firm will buy AI security startup Signal to boost its identity management security capabilities. The deal for Signal, spelled SGNL, is valued at $740 million, according to CNBC. The deal expected to close in the first quarter of fiscal year 2027. Coming up, we're on the ground at CES talking to Qualcomm CFO about the company's big announcements. Stay tuned. You're watching Market Catalysts. The biggest tech event of the year is happening this week in Las Vegas, and Yahoo Finance's Dan Howley's at CES. He sat down with Qualcomm CFO to discuss the company's big announcements.
What is the big takeaway for you from CES right now?
We're incredibly excited. I mean, this has been one of the most interesting CESs for us, and we're very excited about the announcement we've done on robotics. You know, we've been the leader in physical AI within automotive for ADAS, autonomous driving, for a significant period of time. And we're solving multiple problems. We've built a chip that is high performance, low power, does AI. We have a stack that sits on top of it that manages the hardware. And now we're taking that advantage, that leadership that we've built over, and we're moving it to robotics. Because a lot of the problem statement, physical AI problem statement, is similar when you go from cars to robotics to humanoids. And what these humanoids need to do is be able to see, be able to perceive, be able to reason, make a decision, and take an action. And those are all things that require chips like Qualcomm makes, and it's high performance, low power, and be able to do it on the edge without going to the cloud, and be able to consistently do it with safety for a long period of time. And so very excited about it.
Well, we got this big guy right here.
Yes.
What can you tell me about this? This is running Qualcomm's Dragon Wing chip. Well, here we go. He's grabbing the fruit. What is going on here? What is the chip? What is Qualcomm powering back here?
So this is the new platform that we announced, IQ10. If you think about the robotics problem statement, there are two things you need to solve. There is a locomotion, a motion problem statement, and then there is the brain, the AI problem statement. The platform we've built does both. It's one chip that is able to really control the motion of the device, but then also allow the device to think. There is a tremendous amount of AI capability on the device. And so this robot is looking, it's making a decision based on the color of the plates, the color of the fruit, and then driving the locomotion to pick up the fruit and put it in the right colored plate. It's a simple use case, but what this does is it shows that it is using the brain of the robots and it's using the movement of the robots and bringing the two together to make an action that then can be replicated in several other things that the robot can do.
For something like this, there's robots kind of galore here at CES. Thankfully, they're not going to overthrow us yet. But at what point do we start to see these kind of hitting the real world, kind of entering mass production in industrial settings, things like that?
Yeah, I think what we've seen so far in robotics is largely purpose-built robots and purpose action robots. They do specific set of things. I think the next step is you can build something that has a brain now, takes advantage of all the AI progress that we've made over the last several years. You combine it with the motion, and now you can build a special purpose robot that does special things. Like as an example, you can have something that is in an industry, that's in a warehouse, that's in a manufacturing line, even in a home, that does very specific set of actions. The nirvana then is to have a general purpose humanoid that does all kinds of actions, that can think and perceive and see like a human being. I think we're a little away from that, but the next big step is to build special purpose humanoids that can do a lot of actions that we can do, and they're consistent, high efficiency, and they can do it for a very long period of time without getting tired, without needing a break, without needing a battery charge if you use a Qualcomm chip in it.
I want something that can fold my laundry and take the dishes out of the dishwasher, but outside of just robots, you guys also have an announcement that you're working with Hyundai. What can you tell us about that?
Our automotive business has been one of the strong stories of Qualcomm. We've been able to leverage our core technology created for handsets and then apply it to what we call the digital chassis for the automotive. So we build connectivity chips, help the car connect to the cloud. We build the cockpit chips, which is the inside of the car and drive magic into it. And then we build the autonomous driving chips. And all these chips, we're seeing tremendous traction across OEMs globally, independent of the geography of the OEM. And the Hyundai announcement is another step in that direction. I think they've been a very good, very strong partner for a long period of time, and this announcement is an extension of our relationship.
This is just part of the broader strategy, right? For Qualcomm, for years it's been Qualcomm's the smartphone company, right? You have chips in Samsung devices, you have your radio chips, you have the licensing business as well. Now you're in PCs, you're in robots. There's can't see it on camera, but there's a digital bird feeder. Which is pretty cool if you like birds. Where do you see this kind of going? When do you see the other businesses overtaking the smartphone side?
I think we've laid out financial targets very clearly. I think we are going to see our automotive and IoT business grow from 8 billion to 22 billion revenue over the next 3 years. And so very excited about the trajectory we are on. But that did not have any assumption on humanoids and robotics. It did not have any assumptions on data center. And what we're really seeing is as the world is changing, our technology is becoming relevant to the most important transformations that are happening in the world. If I think about the most important transformations that are happening, it's physical AI, which is ADAS and robotics, it's data center, it's personal AI devices, whether it's glasses or some kind of wearable device that can see what you can see, that can hear what you can hear. And all of those technologies, Qualcomm is at the center of the transformation, and so we're very excited.
All right, Akash, thank you so much for joining us.
Coming up next, how to invest in media, entertainment, and sports for 2026 through a new ETF. We got much more coming up. You're watching Market Catalysts. Sports teams have increasingly opened up to public ownership, and as recent sports deals set new benchmarks for team values, Gabelli Funds is trying to unlock a new avenue to dip into the business of sports and sports-related industries. Here with more co-CIO of Value at Gabelli Funds, Chris Morangi. Chris, it's good to see you. People like to have a little piece of sports teams because they're emotionally connected to them in many cases. But why did you think was the right time now to look at? I mean, there aren't that many equities out there as a way to get into this. Why did you guys feel like now was the right time to kind of look at this?
Well, first of all, it's great to be here. This belongs to the broader theme of live entertainment, against which there are a number of secular tailwinds. You just had a reporter at CES. That's the home of the Sphere, which is a great place to go, technological marvel, great place to see a concert. That's a public company, Sphere Entertainment. The Rockettes just celebrated their 100-year anniversary, had their best year in 25 years. Madison Square Garden Entertainment owns that. And then sports and the sports ecosystem are the biggest part of live entertainment. We recognized a number of years ago that was going to be differentiated and more companies to invest in. So we thought this was the right time, enough public companies, enough targets where we could make a product work. And we're very excited about this going forward.
And how are the dynamics of the live entertainment business right now, right? Because we see ticket pricing going up, so people and affordability being a concern. So I'm curious what your outlook is in terms of sort of that
people are willing to spend and very happy to spend on.
Go ahead, Chris.
Sorry. Consumers, it turns out, are very happy to spend their marginal dollar on live entertainment and sports. You just look at ticket prices at both concerts and sporting events, what it costs for that hot dog, et cetera. And that's one of the reasons that this is so attractive. You've got a lot of pricing power, a significant portion of recurring revenue, low capital intensity, good margins. So in addition to these being attractive emotionally and tribally, they're actually very good businesses.
Well, what about any kind of regulatory risk going forward? You know, there's been some scrutiny of the live entertainment industry to some extent. Does that have any sort of overhang for some of these companies?
Yeah, so I think you're alluding to some of the DOJ scrutiny of Live Nation, which owns Ticketmaster, and some of the ticket pricing practices. Obviously, we'll see how that plays out. I think the market has discounted a pretty grim scenario on the whole for that company that doesn't ultimately come to fruition. Again, as a diversified portfolio, it doesn't really impact the sports teams directly. And again, one of the reasons that we think sports in particular is attractive is that they are somewhat immune from a lot of the issues that the market is concerned about, geopolitics, et cetera.
We talked to an investor earlier in the week who holds Atlanta Braves, among other things, and talked about a new tax change coming into effect in 2027 that will change how some of the highest paid employees are accounted for. Now, at a regular company, the highest paid employees are the executives, but at a sports company, it's not necessarily the executives, right? It's the players. So is that something you're watching, and do you expect to have an effect on these companies?
Yeah, so what you're referring to is this portion of the tax code called 162M. We don't need to get into too much detail on that, but that's a correct interpretation. Obviously, a lot of the public sports teams are going to have to deal with that. If it does go through, I think there's a reasonable probability that component of the changes in the tax law gets fixed. But it would be, I think there are ways around it, but one of the ways to get around it is to take these companies private. And that may be a reason that the Braves ultimately go private to the benefit of those who own that entity. And our clients have long been double-digit shareholders of the Atlanta Braves, and we own it in this ETF.
In general, when you look at this ETF and sports-related companies in general, how should people be sort of thinking about what role it plays in their portfolio? Is it growth? Is it defensive? Is it something else?
I think it's a little bit of everything. It's in many ways what we would call the anti-AI play. Obviously, AI is going to be the theme in the market for the foreseeable future. There'll be ups and downs, and this is, I think, a pretty steady, defensible theme that's not directly related to AI. Hard to displace, disintermediate with AI. But there are a lot of growth opportunities, especially as the universe of buyers for sports franchises widen. That's one point we haven't talked about. There have been some recent changes in league rules that allow private equity and sovereigns to participate. Seen that already and think that continues.
So in terms of catalysts this year, that would be, I guess, something that you would be potentially watching for.
Definitely. And you just look over the last 3 months, you've had the Lakers, the New York Giants trade for over $10 billion. Toto Wolff's F1 team trade for over $6 billion. So these prices keep going up. And we think that probably continues.
Chris, good to see you. Thanks so much for joining us.
Thanks for having me.
That's it for Market Catalyst. This is Yahoo Finance.